Hey guys, so today we're going to talk all things remortgaging, and you're probably going to laugh at me, right? But when I think of that word remortgage, I think of a bit of a victory dance because a remortgage helps you do two key things. It helps to stop your monthly mortgage payments going up as soon as your mortgage deal comes to an end, and it also helps you save a lot of money. And we know what money saving does for us. It helps us increase our savings rates, boosts our investments, and ultimately saving money helps us get closer to our goals a lot quicker. So today I want us to really dive in and really embrace this subject of remortgaging because it's on our side and in our interest to make sure that we are remortgaging our deals and doing it as early as possible. The number of people I know and I've come across who have their deals expire and then move on to the standard variable rate is completely unbelievable. And they're paying out so much of their hard-earned money each month to the banks, when we can actually take the steps, be proactive, and remortgage our products. So today I want us to dive in and explore the key questions. What is a remortgage? When should you remortgage? How should you go about doing it step by step? And essentially, what's the entire process for remortgaging your property? My name's Ken of the Humble Penny and Financial Joy Academy. What we do on this channel here, guys, is to give you the tips, the insights, the practical hacks to help you work towards a dream life of financial independence and money joy. I'd love to ask you a favor. If you're enjoying this video as you go through, if you find these various steps and tips I'm going to share really useful, come on, make sure you hit that subscribe button. Show some love to this channel. Subscribe because the growth of our channel really helps to get us in front of other people in order for our videos to help them as well. All right, let's dive in now and explore all things remortgaging. So what is a remortgage? A remortgage is a process whereby you essentially take out a new mortgage on a property that you already own, or you essentially take on more borrowing against that same property, okay? Essentially, you're getting yourself a new mortgage deal. A good example is you are on a 2-year variable rate, for example, or a 5-year fixed rate, for example, and those mortgage deals are coming to an end. And the minute they come to an end, you get moved on to the standard variable rate, which is typically very expensive. So this video is here to guide you through the process of doing your remortgaging successfully and making it as pain-free as possible. So when should you remortgage exactly? A lot of people tend to wait until a couple of months just before their mortgage deal. And worst is when people wait until their mortgage deal has actually ended and therefore they end up paying a lot more when they move on to the standard variable rate. The ideal time for you, if you're being super practical, is to start to go through the remortgage process, which we're going to go through on this video step by step. Begin to do that around 6 months before your deal ends. Yes, 6 months, because there's so much that can happen in those months that can mean that your process can get delayed for one reason or another, and you don't want to be in that place. What you want to do is start 6 months early and go through the process of remortgaging and simply just sit back and just wait for that remortgage, that new product to take effect on that date when your old deal ends. Okay, so do not wait for just a month or two before. Start 6 months earlier and begin going through that process one step at a time. Okay, so what's the process for how to remortgage your property? Let's dive into it. Step one is to check with your existing lender what other products they have available to you, okay? The beauty of doing this is that this is often known as a simple product transfer, okay? And it's a much quicker process to go through because it avoids you having to do kind of lengthy credit checks or completely cuts out the need for solicitors. It takes around half the time to actually go through this process of sticking with your existing lender, and the new deal that you might sign up with your existing lender essentially gets activated as soon as your old deal ends. Now, as convenient as this process is with your existing lender, it might not be the pathway to save you the most money unless your loan to value has changed considerably since you took out your original deal with your lender. Let's say, for example, that you maybe had a 75% loan to value previously, say a few years ago, and then now you've come to remortgage and you now have a 60% loan to value or below, then yes, you probably get a much better deal with your current lender. But if your goal is ultimately to save money, which is our goal, of course, with this entire process, then I'd highly recommend that you move on to step number 2. And step 2 is for you to check what deals you can get with other lenders. Okay, so get onto Google, for example, and type in Mortgage Comparison UK, for example. There are many brokers online that you could use to essentially find new mortgage deals. These are essentially mortgage comparison websites. But make sure that the one that you choose has the option for including direct only deals. These are deals with mortgage lenders that essentially cut out the middleman and require you to apply directly with that particular lender. The alternative to using a mortgage broker is for you to go to an independent mortgage advisor. But essentially your goal is to see what other deals are out there that are suited to your exact personal circumstances. And then you want to be able to compare that to what we did on step 1, where we looked at the options that were available from your current mortgage lender. Step number 3 is for you to check for fees and interest rates on your potential new mortgage deal. Now, this is such an important point because something very interesting that lenders have done over the last few years is essentially to create this idea of an upfront product fee. Now, you might look at it and go, yeah, it's just a fee of £999 or £1,999 and that's it, but you're getting yourself a lower interest rate. I'd caution you to really think about that, because essentially what they've done is they've bundled the returns that they're getting from the mortgage deal into the upfront fee that you are paying. Okay, so it might look like you're getting a really good interest rate. What they've done is essentially moved their returns onto the fee itself. And so what you want to do here is, if you are using one of those mortgage comparison websites, you want to make sure that you understand the impact of the entire mortgage product. So make sure that when you have entered your details, such as your current loan to value, the amount you're trying to borrow, the current valuation of your property, and how long you want to borrow, these are all inputs on those mortgage comparison websites. Once you've done all of that and it's shown you all your results, you want to make sure that you filter by the initial term cost. Initial term is the period over which you are getting that favorable mortgage rate that you're getting. Let's say you're getting yourself a 2-year tracker or a 5-year fixed rate. So if you filter by the initial term cost, the system will give you the cost based on that initial term only. Whereas if you filter by, say, monthly cost, for example, it might give you the cost over the entire term of your mortgage, say over 20 years or whatever, therefore hiding the impact of that initial upfront fee. Another way for you to check the impact of that upfront fee, if you're not using a mortgage comparison website, is for you to simply grab your phone and get the calculator app on your phone, for example. Let's imagine that you are paying a fee of £2,000 as a product fee over, say, 24 months for a 2-year tracker product. Simply take £2,000 divided by 24, should give you around £83 per month. That there is the real impact of that upfront product fee that you are paying. It's an additional £83 cost to you. Another tip tied to this very point on the product fees, to make sure that if you are going to choose a product with a product fee, do please make sure you pay the product fee upfront. Why? You always have the option of adding that product fee onto your actual mortgage itself. But the thing is, to note with that is that that fee that you're adding, say £2,000 that you're adding to your much larger mortgage, activates compounding interest. Because the minute you add it onto your much larger debt, it also starts to bear interest every month, and that then creates that compounding machine and essentially makes you poorer over time. So if you can, do the best you can to pay it off upfront, if you can, when you take out your remortgage product. Other things to watch out at this stage is for you to look out for things such as cashbacks and free valuations. those tend to be perks that are added to certain mortgage products to make them more attractive. I've personally had those in the past. I've found them to be useful to have a cashback of maybe say £500, for example, because it ultimately reduces the overall fee that you are paying. But keep in mind, your goal is to make sure that you understand the full impact of not just the upfront fee that you're paying, but of the interest rate over that initial term period where you are getting that favorable rate from your new lender. The final thing to watch out for in this stage is the early repayment charge, okay? Now, if you are somebody who is looking to overpay their mortgage, for example, and you're happy to stay within, say, a 10% limit for overpayments, then you might be okay with a product that just has a 10% early repayment charge, which is usually tied to fixed rate products. But if you're somebody who is perhaps pursuing a goal of paying off their mortgage early and you expect that you might be paying off more than 10% per year potentially, then at this stage of your remortgaging, you want to make sure that you are getting a product suited to your circumstances. You want to make sure that you're getting a product that allows you that freedom to overpay beyond 10%. This is something that we did, although we started off with a fixed rate product, which is very popular, by the way, because a lot of people can predict how much they are spending on their mortgages. We then moved on to a variable product that gave us the flexibility to overpay beyond 10%. So I'm making this point just so that you can bear it in mind as you're looking at these various mortgage products and what key features you need in them in order to satisfy your personal needs exactly. Okay, so you've now looked through all those mortgage products and you've seen one that really suits your needs. Step 4 is to put in a mortgage application with your potential lender. So this is assuming that you're perhaps not going with your existing lender and you're maybe going with another lender because you're likely to save a lot more money that way. What happens at this stage is that they will do some checks on you. They will ask you for various things such as your pay slips. Essentially, they'll go through an affordability process to make sure that you can afford your new mortgage. They will also go through a process of doing a valuation or a survey to make sure that that property is worth what it should do in order for you to be able to get that mortgage product. If they are happy with, say, the documents that you've submitted, as well as the valuation that they've carried out, you then get given a mortgage offer. This is the exciting stage. You finally got yourself a mortgage offer, which essentially is a document that states that you are being approved for a mortgage with that specific lender. Okay, step 5 is the legal process carries on and your solicitor will receive the mortgage offer from your new lender. And with that new mortgage offer, they can therefore request a redemption statement from your previous mortgage lender. And with that, they go through a process of essentially paying off the mortgage that you had before, such that your new lender therefore replaces your old lender as the provider for your mortgage on your property. Step 6 is looking at like-for-like remortgaging versus borrowing extra money. Now, if you're doing a simple like-for-like remortgage, i.e. you had a particular mortgage and a particular amount you had on it, but then you went to remortgage and you did not borrow any more money, that's a simple like-for-like remortgage. And that's very straightforward and you go through the process we've been through so far. Now, let's say you are somebody who wants to borrow more money. At this stage, further checks will need to be made, particularly to look at, first of all, what is the equity that you have on the property? And tied to that, does the equity you have in the property give you enough of a margin for you to borrow more money, provided that you are within the loan to value requirements of the new mortgage you're taking out. So let me explain. Let's say, for example, that you are taking on a new mortgage product with a 90% loan to value requirement. And let's say that the property value is, say, £400,000. 90% of that is £360,000. And within that £360,000, that £360,000 will essentially be the maximum that you can borrow, combining the remortgage plus the additional borrowing that you might want to take on. Essentially, those two amounts summed together have to come in within the 90% loan to value for that very example that I gave. Essentially, they want to make sure that you're not over borrowing and that the borrowing that you are taking on, the additional borrowing, matches the mortgage product for which you are applying. Step 7 is essentially the end of this process. It's looking at payments. So let's assume now you've gotten your mortgage offer, you've successfully remortgaged, yay, all has gone well, and you have now crossed that line where you've remortgaged. This final point is this very simple one. It's just for you to make sure that you understand the key terms of your new mortgage, make sure that you know what your key dates are, i.e. when is your new mortgage payment date going to be, because the last thing you want is for that mortgage payment date to show up and you don't have, the amount of money you need in your bank account. So make sure that's all done, your direct debits and everything's all being set up properly, or if you're making any standing order payments, those standing order payments have been set up properly for the right date. And that's it. Happy savings, because you've been through a process of essentially remortgaging and beginning that walk to freedom, essentially, where you're saving money. And this is the key thing. You're saving money to enable you to be able to invest in other areas of your wealth building journey. And that could include making overpayments on that very same mortgage, or simply investing your money through the stock market. Guys, thank you so much for watching this video today on how to remortgage a property step by step. I really hope you've enjoyed it. If you've really enjoyed it, I'd love for you to make sure you hit that subscribe button, because it really helps our channel to grow and get our message in front of a lot more people. Please also make sure you hit the like button, because it really helps to encourage a ton more people to watch our videos. I'd love to ask you one question though. When is your current mortgage deal coming to an end? When exactly is that happening? Is it a month away? Is it 6 months away? And as a result of that question I've asked, when are you due for a remortgage? Please let me know in the comments. When is your deal up for a renewal? And finally, given this is a video about remortgaging, what questions have you got for me relating to all things remortgaging? Please drop them in the comments and I'd be more than happy to jump in there and share a lot more of my knowledge around this subject of remortgaging your property. Thank you so much for watching this video today. Do please make sure you share it with others, and as ever, in all things, be thankful and seek joy. Take care and bye for now.